Trying to keep up with everything happening in the financial world these days, it can feel less like staying informed and more like trying to dodge rhetorical grenades.
Yeah.
Especially when you're constantly hearing these really dramatic predictions about market crashes, currencies collapsing, economic doom just around the corner. It's exhausting.
It really is. And adding fuel to that fire, sort of making the noise even louder,
Yeah.
is a figure many people know. Robert Kiyosaki, the author of Rich Dad, Poor Dad,
Right.
he's been incredibly vocal lately with some pretty provocative macroeconomic forecasts. I mean, we're talking specific warnings about the U.S. bond market failing, claims the Fed is secretly printing money, and asserting that hyperinflation isn't coming, it's already here. It's certainly amplified a lot of anxieties out there.
Absolutely. And that's exactly why we're doing this deep dive. You've shared like a whole stack of sources with us, articles, research papers, analyses that offer a data-driven look at these exact claims.
Our mission is clear: to take Kiyosaki's specific assertions, put them side by side with credible data and, expert consensus drawn directly from these sources,
Right.
and help you navigate this complex, often sensationalized landscape. The goal is really to cut through the noise and give you a balanced, data-backed perspective so you can make more informed decisions.
This is about getting grounded in the numbers, yeah. Seeing what the data actually says versus maybe the most dramatic headlines. Let's dive into it.
Okay, let's unpack this.
Okay.
So Kiyosaki's most dramatic macroeconomic warnings, they kind of boil down to three key points we see discussed across the sources.
Okay.
First, the U.S. government bond market, he argues, is failing. Second, he claims the Federal Reserve is engaged in secret money printing. And third, that hyperinflation is not a future threat, but like a present reality.
Wow. Okay, that's a powerful set of claims, especially the bond market failure. He's specifically pointed to U.S. government bond auctions, suggesting they've failed because investors just aren't showing up. How do these auctions work, and what would a real failure even look like?
Right. Well, U.S. government bond auctions are basically how the Treasury Department raises money to fund government operations. They auction off debt, Treasury bills, notes, bonds. Investors place bids, the Treasury accepts them, and that determines the yield, the interest rate. Success is typically measured by things like the bid-to-cover ratio.
Okay.
So the total value of bids received versus the amount of debt offered, and also the quality of bids, like how much comes from direct investors versus these primary dealers.
Gotcha.
A truly failed auction would mean there simply wasn't enough demand at acceptable prices. That could force the Treasury to significantly raise yields or potentially even scrap the auction entirely. That would be a huge deal.
Okay. And the sources point to a specific auction that likely sparked this claim from him, right?
They do. Yeah, analysis in the sources strongly suggests his claim probably focuses on a particular $58 billion auction of 3-year notes back on April 8th, 2025.
Hey, April 8th.
And that one was described by some analysts as having ominous signs and being objectively terrible.
Objectively terrible.
Yeah.
Wow.
It printed a 2.3 basis point tail, which basically means the average yield accepted was a bit higher than the lowest accepted yield that's seen as an indicator of weaker demand than hoped for, or at least at those lower yields.
Okay.
Plus, there was a lower than usual percentage of bids from direct investors, people outside of the big primary dealers.
Okay, so looking just at that one auction, I mean, you can maybe see why someone might point to it and say, see, demand is weak.
Right.
But what's fascinating here is what happened literally the very next day, according to the sources.
Yeah, what's truly striking is the contrast. The very next day, April 9th, the Treasury held a $39 billion auction for 10-year notes, a different maturity. And that one saw very strong demand. It actually surprised many market participants because demand from indirect bidders, large institutions, foreign central banks, was exceptionally high, like 87.9%, well above the average.
Wow, okay. So you had one auction on Monday described as terrible, and then the very next day, an option for a different type of bond described as having very strong demand. That feels like a much more nuanced picture than just investors aren't showing up.
Precisely. The sources really show the Treasury market is incredibly vast and complex. Demand isn't uniform. It varies significantly based on the type of bond, its maturity, the current market conditions, what global investors need at that specific moment.
Right.
So that 1 week, 3-year auction, well, yeah, it was notable. It's just one data point in the market that processes trillions of dollars in debt across various auctions constantly.
And the sources mention other recent positive signs too, don't they?
Yes, definitely. For example, there was a long-term bond auction. like a 29-year, 11-month bond back in
Hmm.
March 2025. It had a healthy bid-to-cover ratio of 2.37. And recent May 2025 auctions for things like 30-year bonds and even short-term 4-week bills saw significant amounts accepted at solid yields, like 4.819% for the 30 years and 5.400% for the 4-week bills. Pretty strong demand there.
So when Kiyosaki says the auction failed investors did not come, it really seems like a massive overgeneralization, doesn't it? It ignores the complexity and the contradictory evidence from auctions happening almost at the same time, as detailed in the sources.
That's the key takeaway from the data presented. The overall picture is one of a dynamic market with, yes, fluctuating demand, but not systemic failure or a complete lack of investor interest across the board.
All right, let's move to his second big claim then. The Fed is secretly printing money. I mean, this sounds pretty serious.
Yeah, what's fascinating here is that the Federal Reserve's publicly stated policy since June 2022 has been the exact opposite of printing money. It's quantitative tightening, or QT.
Right, QT.
This means they are intentionally shrinking their balance sheet. They let assets they hold, like Treasury securities, mature without reinvesting the proceeds. The sources note the FOMC, the Fed's policymaking committee, reaffirmed this policy just recently, May 7th, 2025.
And under this explicit QT policy, the Fed's balance sheet has actually shrunk significantly, hasn't it? By quite a lot.
Correct. Since QT began, their balance sheet has decreased by over $2 trillion. This whole process is designed to withdraw liquidity from the financial system, which is part of their strategy to, combat inflation.
Okay, but the sources do mention a recent report that seems to show the Fed buying assets, which I guess sounds like printing money to some people.
Yes, there was a MarketWatch report highlighted in the sources. It noted the Fed quietly purchased $43.6 billion in U.S. Treasuries in just 4 days recently, including a notable amount of long-term bonds. Some analysts did label this stealth QE.
So could that be what Kiyosaki is pointing to as secret money printing? Is that the smoking gun?
Well, if we connect this to the bigger picture, while, look, $43.6 billion sounds like a lot, and it is a significant operational move, you really have to view it in the context of the over $2 trillion that have been removed from the system under the stated QT policy.
Ah, okay. Scale matters.
Hugely. The sources suggest these purchases are more likely operational adjustments the Fed makes, things like ensuring smooth functioning in the Treasury market or managing bank reserves. They're probably not a strategic reversal of QT or some systemic effort to print money because the government can't find buyers for its debt.
Right.
This report does highlight an apparent contradiction between maybe isolated actions and the publicly stated policy, which is why understanding the full context, the overall $2 trillion balance sheet reduction is so crucial.
Got it. So not a secret strategic shift to print money on a massive scale to fund debt, but potentially necessary operational moves within the larger stated policy of shrinking the balance sheet. Makes sense.
That's the distinction the sources seem to draw, yeah.
Yeah.
Based on the scale and the stated policy versus isolated events.
All right, third big claim, and maybe the scariest, hyperinflation is here. Now, what exactly is hyperinflation? Just so we're clear.
Good question. Hyperinflation, as defined in the sources, is an extreme and incredibly rapid form of inflation. It's often considered to be over 50% per month.
Per month? Wow.
Yeah. The consequences are just catastrophic.
Mm.
The currency loses value almost overnight, leading to economic collapse and severe instability. The historical example everyone points to is Germany's Weimar Republic in the 1920s.
That's terrifying. So how does the current U.S. inflation picture compare to that, according to reputable forecasts from the sources we looked at?
Well, the sources indicate inflation has been persistent and progress in getting it down has been, let's say, bumpy. But annual core CPI is currently running somewhere between 3.3% and 3.8%.
Okay, so way off 50% a month.
Exactly. And crucially, forecasts from major institutions consistently show something very, very different from hyperinflation. For instance, the University of Michigan projects PCE inflation, that's the Fed's preferred measure, to actually decline to a steady 2.2% from late 2025 through late 2026.
Okay, declining. And Deloitte's baseline, what did they say?
Deloitte expects CPI to remain, quote, stubbornly high relative to the Fed's 2% target. They project 2.8% for 2025 and expect it to stay above 2% beyond that, but they explicitly state this forecast environment is not hyperinflationary.
Right, not hyperinflation. And RBC's forecast also paints a challenging picture, but again, not catastrophic.
Exactly. RBC forecasts core CPI may be rising slightly higher to 4.4% by the end of 2025 and staying above 2% through 2026. They acknowledge kind of stagflationary tilt, but they're very clear. We are far from the levels of inflation and growth that characterized the 1970s or the pandemic. And Yale's analysis points to debt risk maybe increasing price pressures over time, but again, does not forecast hyperinflation.
So when we look at the consensus view from these reputable institutions, it seems pretty consistent.
Yeah, what stands out is that while inflation is definitely a real concern, and forecasts suggest it may remain above the Fed's target for a while, maybe even ticking up short-term due to things like new tariffs, they are nowhere near hyperinflationary levels. The overwhelming consensus points to a moderation or persistence of inflation, not some acceleration into catastrophic currency collapse.
It's a critical difference, isn't it? Persistent, elevated inflation is a challenge we're dealing with, sure, but catastrophic hyperinflation based on these sources really looks like an unsubstantiated claim.
That's the key distinction the data supports, yeah. The current economic situation, while it has its challenges, is fundamentally different from the conditions that actually cause hyperinflation.
Just briefly, the sources touch on Kiyosaki's track record with predictions. He's known for these bold claims. Has he been right on anything significant before?
Well, he has had some successful calls, which the sources do acknowledge. Notably, he correctly predicted Bitcoin would exceed $100,000 by May 2025, which it did briefly touch. He also previously predicted a Bitcoin correction, which happened. However, his broader, more extreme macroeconomic warnings, systemic collapse, imminent crashes haven't consistently materialized, according to the analysis and the sources. He definitely aligns with the more extreme end of hard money advocates who see an inevitable debt doom loop and broken money. That's a much more dire outlook than the consensus.
Okay, so his most traumatic macro warnings seem questionable when stacked against the data we have here, but he's had some specific asset predictions pan out. Let's actually look at those assets he constantly recommends as hedges against the collapse he predicts: gold, silver, and Bitcoin.
Right. He positions these three as the essential assets to own in what he sees as a crumbling financial system.
Let's start with gold then. He's made headlines by saying things like gold will go to $25,000, which sounds huge. What's been driving gold's price recently, according to the sources?
Yeah, gold has seen a strong run lately. The sources point to several factors. Sustained buying by central banks globally, elevated geopolitical tensions driving that safe haven demand, expectations of future interest rate cuts from central banks, which make non-yielding gold more attractive, and also some weakening U.S. dollar dynamics. It's kind of playing its traditional role as a hedge.
All right, $25,000 gold. How does that stack up against other expert forecasts? Is anyone else saying that?
That $25,000 target is, well, it's highly unconventional. Very much an outlier. What's kind of fascinating is the sources point out Kiyosaki's own more specific, less sensational forecasts for gold have actually been much lower, like $3,300 by August 2025, or a general $10,000 target he's discussed elsewhere.
Oh, interesting. So even he has lower targets sometimes. And what are major banks and other analysts forecasting for, say, 2025?
For 2025, the consensus range from reputable institutions like Wells Fargo, Citigroup, Goldman Sachs. Yeah. It's generally between $2,900 and $3,700 an ounce. Even Peter Schiff, who's a well-known gold bull, has a target of $5,000. When we look at longer-term forecasts from the sources, say out to 2026 or 2030, they go up, sure, but maybe to around $6,000. That's JP Morgan. $10,000, Larry Leopard, another bull. Or perhaps peaking around $5,155, Investing Haven.
So $25,000 significantly exceeds even the most bullish long-term forecasts from other experts. And even Kiyosaki's own more specific predictions we just mentioned, it seems more like, what, a rhetorical flourish? To emphasize his warning rather than a serious data-backed near-term price target.
That's exactly the analysis presented in the sources. While gold clearly has fundamental drivers and a role in diversification and hedging, tempering expectations based on these consensus projections seems key. Chasing that 25K number seems unwise based on this data.
Okay, next up, silver. He claims silver up to $70. What factors influence silver's price? It's a bit different from gold, isn't it?
It is. Silver is interesting because it's kind of a dual-purpose metal. It's a precious metal like gold, yes, offering some safe haven characteristics, but it also has significant and growing industrial demand.
Industrial demand, like...
Yeah, the sources really highlight its use in green energy technologies. Think solar panels, electric vehicles. That's a major driver. Price is also influenced by things like supply deficits, shrinking inventories, monetary policy shifts, tariffs, and its valuation relative to gold, that gold to silver ratio people watch.
Right. And how does this $70 target for silver look compared to forecasts? Is that as much of an outlier as the 25K gold?
Well, unlike his gold target, $70 is actually within the realm of possibility, but primarily as a long-term projection, based on the sources we reviewed.
Okay. Long term, what are the typical forecasts for silver in, say, 2025, and then looking further out?
For 2025, forecasts from sources like ANZ and JP Morgan average around $36. More optimistic forecasters like Peter Krauth and Yulia Kondachko see maybe $40–50. Investing Haven projects a maximum around $49.
So not $70 next year generally.
No. But when you look further out into maybe 2030, some forecasts do hit or exceed that $70 level. 99bitcoins.com projects $75–90 by 2030, and Investing Haven sees a peak around $82 by 2030.
Okay, so his $70 target aligns more with the optimistic long-term views for several years down the road, rather than suggesting an imminent move.
That seems to be the key distinction the sources make. While the implied time frame in his messaging might feel aggressive, the bullish sentiment for silver reaching those kinds of levels eventually is shared by others, largely because of its strong industrial fundamentals and its role in the whole green transition. But, it's typically more volatile than gold.
Good point. Finally, Bitcoin. He's been very bullish here, recently reaffirming a $250,000 target by the end of 2025.
Yeah.
Referencing an AI model predicting $500,000 by 2025 and implying maybe $400,000, $600,000 by 2030. And as you mentioned, he did successfully predict BTC would exceed $100,000 by May 2025. So he's got some track record there.
He does. And Bitcoin has certainly been a high momentum asset. The sources highlight several key catalysts for that. There's growing institutional adoption, particularly with the launch of those U.S. spot ETFs. That's been huge. It has that built-in scarcity mechanism with the halving events, and it's increasingly seen by some as digital gold 2.0, partly due to waning trust in traditional fiat currencies, perhaps.
Right, digital gold. And what are other experts and institutions forecasting for Bitcoin? Are they anywhere near his numbers?
Well, many are indeed projecting six figures for 2025. Standard Chartered, for instance, forecasts $120,000 by Q2 2025 and maybe $200,000 by year-end. Bernstein and Van Eck have targets around $180,000 to $200,000. Finder and Benzinga surveys show average targets around $161,000 for 2025.
Okay, so high, but not 250K generally for 2025.
Not generally, but it's worth noting that some very optimistic experts like Joe Burnett and Arthur Hayes do share that $250,000 by end 2025 target. So he's not totally alone on that one.
Okay. And long term, the forecasts get even higher, right? Like really high.
Much higher, yeah. For the 2028-2030 timeframe, Standard Chartered sees $500,000 by 2028. Joe Burnett and some Benzinga analysts are talking near $1 million by 2030. Kathy Wood's ARK Invest is even more bullish, projecting maybe $1.5 million to $2.4 million by 2030 based on their long-term view.
Finder's average forecast for 2030 is over $400,000.
Wow. Okay, so his $250,000 target for 2025, while ambitious, is shared by some optimistic experts. And his higher targets for $400,000 plus are definitely echoed by a number of prominent analysts and institutions, though maybe more on a 2030 timeline typically. This feels different from the gold target where he seemed way out there.
It does feel different. What's fascinating here, I think, is that it reflects a growing belief among certain institutions and analysts in Bitcoin's long-term potential as a legitimate asset class and maybe a store of value, that digital gold role that seems to be gaining traction.
Right. However, and the sources absolutely emphasize this, Bitcoin remains highly volatile. Those high upside potentials come with commensurate risk and the potential for significant price swings based on market sentiment, regulation, the broader macro environment, all that stuff.
Absolutely. So, okay, we've broken down the macroeconomic claims, which seem largely unsupported by the detailed data from the sources, and the asset forecasts, where gold's highest target seems rhetorical, silver's aligns with optimistic long-term views, and Bitcoin's high targets are shared by some, particularly in the long term. How do you, the listener, take all this information and navigate the financial world, especially when you're bombarded with these really dramatic predictions?
That's the absolutely critical question, isn't it? Sensational predictions like the ones we've discussed, they're often designed to grab attention, induce fear, and potentially push people toward immediate, often irrational actions.
Yeah, buy this now or you'll miss out. Or sell everything.
Exactly. The counter message, which is strongly highlighted across the sources we looked at, is really rooted in time-tested, data-driven principles.
Okay, let's explore those principles. Principle number 1, the importance of diversification. Sounds basic, but crucial.
It's foundational for managing risk. especially in uncertain times like these.
Mhm.
Diversification just means not putting all your eggs in one basket.
Mm.
It's about spreading your investments across different asset classes, stocks, bonds, maybe real estate, commodities, perhaps even alternative investments like certain funds, as mentioned in the sources.
Right.
The goal is that if one area performs poorly, others might hold up or even do well, smoothing out your overall returns. Concentrating your wealth, even in assets perceived as safe or high return, just leaves you vulnerable. Historically, diversified portfolios have proven much more resilient over time.
Makes sense. Principle number 2, maintaining a long-term perspective. Easier said than done sometimes.
Definitely. Your investment strategy should always be anchored to your specific financial goals, whether that's retirement in 30 years, a down payment in 5, funding education, whatever it is. Those goals provide your framework. A common pitfall, often fueled by sensational headlines and volatility, is overreacting to short-term market movements.
Like panicking and selling during a dip, for example.
Exactly. And historical data shows that downturns are typically temporary. The average bear market, I think, lasts only about 10 months or so. If you exit the market based on fear, you risk missing the subsequent recovery, which is often sharp and rapid. A disciplined long-term approach helps you ride out these cycles and directly counteracts that urge to make hasty emotional decisions based on short-term noise.
Okay, so diversification and long-term view. And how do gold, silver, and Bitcoin fit into this framework? Should people just ignore them or?
No, they can play a role. Gold and silver have that long history as hedges against inflation and economic uncertainty. They're often called hard money for a reason. Bitcoin, as we discussed, is increasingly seen by some as digital gold and a potential hedge against fiat currency issues, offering potentially significant upside, particularly from growing institutional adoption.
But they aren't presented as the only answer, right? Not the magic bullet.
Absolutely not. Crucially, the sources emphasize they should be considered as components within a broader, well-diversified portfolio. They are not the sole solution or the guaranteed path to financial salvation. Your allocation to these, or really any asset, should be carefully considered based on your specific risk tolerance, your investment horizon, your financial goals.
Right.
They can add diversification and potential upside, sure, but they also come with their own risks and volatility, especially Bitcoin.
It really boils down to making your investment choices based on comprehensive, verifiable data and a balanced understanding, doesn't it? Rather than just isolated extreme predictions designed to grab attention or induce fear.
Hmm.
And as the sources also note, seeking objective perspective from a qualified financial advisor can be really invaluable.
Absolutely. Data and discipline beat drama and dogma every single time when it comes to investing.
So wrapping up this deep dive then, while figures like Robert Kiyosaki raise, valid questions about economic health and the role of assets like gold, silver, and Bitcoin, his most extreme macroeconomic warnings, imminent hyperinflation, a failing bond market seem largely sensational and are not really supported by the consensus economic forecasts and detailed market data from the sources we've explored today.
Right. Inflation and the Fed's balance sheet reduction are real factors, sure, but the system doesn't appear to be on the brink of collapse, as he sometimes suggests. His price targets for assets, they vary in their alignment with other forecasts. Gold's highest target seems rhetorical, silver's $70 target fits some optimistic long-term projections, and Bitcoin's ambitious targets are echoed by some very bullish long-term institutional views, but all carry significant risk.
In a world filled with financial noise and these dramatic predictions, building resilient wealth isn't about chasing every sensational headline or doom and gloom forecast, is it?
Not at all. It's built on those time-tested principles. Diversifying your investment across different assets and markets, anchoring your strategy to your long-term financial goals, and maintaining perspective through market fluctuations, and making informed decisions based on verifiable data and a balanced understanding, not on fear or isolated extreme claims.
Which leaves us with a final thought for you, the listener, to consider. In the face of all this financial noise and these competing predictions, how do you build your own personal filter, your own framework to discern credible information from pure sensationalism? And maybe what specific steps can you take today to ensure your investment strategy is built on a solid foundation of data and diversification, rather than simply reacting to the latest wave of fear-inducing headlines?